Good Monday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Donald Trump hints that some trade agreements could come as soon as this week. But in a new front, the US president vows 100% levies on films from outside America. Pump, baby, pump. Brent crude slumps below $60 as OPEC Plus turns on the taps. Meanwhile, Bloomberg learns Shell is studying a takeover of rival BP. Plus, Buffett's bombshell, the 94-year-old sage of Omaha, is to step down as the CEO of Berkshire Hathaway, leaving his successor a cash pile of close to $350 billion. Good morning. Happy Monday then. UK markets, of course, closed with the bank holiday. European equities have been on a run, as have their US counterparts, of course. 9 straight days of gains. The picture turning a little bit more cautious as we head into the open for the other European markets in the US later today, of course. European futures then pointing up by just a tenth, down by just a tenth of a percent, again, after that strong run of 9 straight days of gains. So a little bit of caution creeping into these markets, despite the commentary from Trump suggesting that maybe there are some deals that will cross the line, potentially as soon as this week. The details, of course, will be important. S&P futures stateside looking to losses around 0.7%, again after the strongest run that we've seen in about 2 decades for the S&P 500. Nasdaq 100 futures currently pointed around that 20,000 level, softer by 0.7%. Let's flip the board and have a look cross asset then. No Treasury trading because Japan is on a holiday right now. The Treasuries will start trading later in the day, of course. The Bloomberg dollar index pointing to softness in the greenback in the session today, down 0.3% for the dollar. Euro dollar then benefiting on the back of that. The euro, the single currency, up around 0.3 so far in the session. Gold gaining 0.5% after a week of losses last week for the yellow metal, currently at 3,257. And oil, of course, firmly in focus, with OPEC Plus planning to put an additional 400,000 barrels per day onto the market by next month. Pressure continues, of course, on the oil space, below $60 a barrel right now for Brent at 59, and down 3.6% so far in the session. Let's cross over to Asia right now and check in with Abel Hong, standing by for a check on the Asian markets out of Singapore. Abel.
Yeah, Tom, it's really the focus on Asia currencies today as the dollar slumps given this trade deals optimism. Asia FX is surging ahead. Key among them, the Taiwan dollar. Now, some of this is to do with the markets that are shut. That's exacerbating the FX moves. China, Japan, Korea are shut. But keep in mind as well that the losses of the dollar against the G10 seems to now be spreading against some of these EM Asia currencies. And keep in mind as well that when it comes to short Taiwan dollar trades, that seems to have been quite popular as a hedge against a protracted US-China trade war. So some of those trades are on the wrong side at the moment. So that is influencing the stocks in Taiwan. They are going against the grain versus the wider region that is seeing some green. It's really the export-related names, including your chip-related stocks that are getting hard hit today because of the effect potentially on their views on profits. And not only that, the life insurers are also in focus because some of them are seen as more vulnerable than others. They're not quite hedged correctly. Keep in mind as well that there are winners amid all this. When you look at the Taiwan dollar appreciation coinciding with the climb in Brent, or the slump in Brent, I should say, that seems to be benefiting some of these shippers, the airline-related stocks. I also wanted to show you this chart that it's not just about the Taiwan dollar, also about the likes of the Korean won. If you look at Taiwan dollar, the 2-day moves are the most we've seen since, I think, the 80s. But Korean dollar has also, Korean won, I should say, has also moved past psychological 1400 level. So you really can tell the market dislocation from these dollar moves as well. Tom.
Yeah, the activity in the FX space with the lens, of course, on the Taiwan dollar. Some remarkable moves there, and we'll see how that story continues to play out. Abel Hong, thank you very much indeed in Singapore on those pretty dramatic FX moves in Asia, tying, of course, to what is happening on the trade front as well. Arguably, Donald Trump as well, saying that some trade deals then could come as soon as this week. Speaking aboard Air Force One, the US president says it will be up to him, not other countries, when these deals are completed.
At some point in the next 2 weeks or 3 weeks, I'm going to be setting the deal. I'm going to say that such and such a country has had a tremendous trade surplus their way with us. They've taken advantage of us in various ways. what they were doing. We were being led by people that were not very smart. They were able to be taken advantage of, but I can't be taken advantage of. So at a certain point, I'll be just setting a certain tariff number.
For more, let's bring in our China correspondent, Min Min Lo, because we also heard from the president suggesting that he would lower those tariffs on China at some point. Min Min, what are the prospects right now of real and material talks, even at the lower level, between the US and China?
Yeah, he is certainly softening his stance on China, saying that he would be willing to lower tariffs. He cited that there could be trade deals coming this week, but perhaps more for other countries and not so much for China, because he also did say that he was not planning to speak with President Xi this week. He also said, that China and US officials have been talking about very different things, which suggests the overtures from the US to China so far maybe has not been going on as smoothly as we are thinking about. We know that the Chinese side has said they are considering potential for talks, but at the same time, the Chinese officials have also been calling on the US to remove all unilateral tariffs. And this comes as the Wall Street Journal also reported that China's security czar Wang Xiaohong has been trying to find out what the US actually wants when it comes to fentanyl cooperation. That's a good sign. But the Wall Street Journal also reporting that China is thinking about fielding Wang Xiaohong to meet with US officials, which is an interesting move because we want to look out for who China eventually assigns to oversee the trade talks, because in the first trade war, it was the Vice Premier Liu He at the time. If China doesn't send He Lifeng, the current Vice Premier, then it suggests that China might want to limit the scope of discussions to national security, given that Wang Xiaohong is the Minister for Public Security, maybe just to fentanyl or to TikTok, and perhaps they still want to see certain preconditions fulfilled before they would open up space for a broader base sort of trade discussion.
OK, interesting in terms of what China is thinking about around their point person and that focus on national security. And that actually takes us to what has been happening, the other line to this coming through from President Trump over the weekend. And this is a focus on national security. This is a justification that he's using to limit, arguably, the number of films into the US markets by imposing potentially 100% tariff on films that are not produced in the United States. And part of that rationale seems to be national security. Talk to us what this potentially means then in terms of the movie industry and what the underpinnings are for this.
Yeah, essentially he says that foreign films, basically it's a national security threat because there could be propaganda or messaging being embedded in these films, which some analysts have said is essentially a red herring because digital products these days, the supply chain is so globalized, post-production can essentially be done anywhere around the world. It can be done remotely, although a lot of US films, the pre-production, the conceptualizing, the design of it starts in the US, but production can really take place in many different countries. So the question then comes as to how you're going to implement this, because theoretically it sounds fine to impose 100% tariff, but how do you define a foreign film that is filmed in multiple different countries? How do you calculate the tariffs based on the value of a film when you don't even have the box office numbers for that yet? And of course, there is potentially a geopolitical layer to this because last month China had announced it would moderately reduce the import of US films, citing that favorability of US films among Chinese consumers has been going down because of these tariffs. That was a retaliatory move from China. Could this be a tit-for-tat thing? Perhaps not really, because from the US side, it is more of a universal tariff that will apply to all foreign films. We know President Trump had said this was meant to also reshore production back to the US. We know that spending by US films and TV production firms have been going down over the past years, partly because these companies have been trying to cut back spending to boost their profits, given the shift of consumers from traditional TV to streaming services. So it will be interesting to see how the Trump administration would explain how they're going to implement this new levy.
OK, China correspondent Min Min Lo, thank you for that update. Staying on President Trump, and this time with the focus, of course, of what is happening with the Fed on a big week for the central bank of the US. President Trump insisting then he does not plan to fire Jerome Powell. In an interview with NBC's Meet the Press, Trump says he will not remove the Fed chair.
He should lower them, and at some point he will. He'd rather not, because he's not a fan of mine. He just doesn't like me because I think he's a total stiff. And, it's just one of those things. He should lower them. And I wish the people that are on that board would get him to lower, because we are at a perfect time. It's already late, but he should lower interest rates.
OK, let's bring in Bloomberg's Lauréline now for the market reaction to this. So, Val, pretty clear in terms of his line that he is not going to fire Powell before the end of his term, of course, that expires at some point in 2026. But I have to wonder when the patience of President Trump wears thin, with markets not pricing in a full cut for this Fed until July.
Yeah, that's right, Tom. The market has a little bit swung to Powell's side on this. We are seeing continued calls for that Fed rate cut not to come anytime soon, maybe out in July and September. We're seeing that kind of action happen in the bond market as well. The two-day move in the two-year yield, it has risen the most in nearly 6 months. A 20 basis point move over the last 2 days. A lot of that was helped by the better than expected payroll print on Friday. But the Fed is expected to hold that Fed funds rate steady when it meets on Wednesday, holding it at around 4.5%. And as I mentioned, we heard from the likes of Barclays and Goldman on Friday after that better than expected jobs data push out those Fed calls. They no longer see a Fed cut in June. Both Barclays and Goldman now expect it in July. That really chimes with this market optimism we've had lately, both in the bond market and in the U.S. equity market. Take a look at how the S&P 500 has done. We've now recouped all of the losses since the April 2nd tariff announcement, and we've extended that winning streak, as you mentioned, Tom, 9 days, a 20-year record winning streak for the S&P 500 index.
Yeah, remarkable winning streak, and we'll see if it can continue into this week and to what extent the central bank action will play into the equity moves as well. So we have the Fed, of course, decision, also the BOE. What else are you going to be looking at, Val, in terms of the central banks taking primacy this week?
It's a busy week for G10 central banks. We kick it off with the Fed, probably the most important one of the week. But we also have the Riksbank and the Norges Bank coming on Thursday. They're widely expected to hold. I think we could see some fireworks from the Bank of England on Thursday. They're widely expected to cut. But the questions ahead, well, will they reiterate kind of the ECB's dovish shift? Will they sound quite dovish in their statement? Maybe hint to disinflationary forces ahead from the tariff implementation reaction when it comes to the UK equity market and the UK economy generally. But take a look at the front end of what's happened in the UK two-year yield. This is the movement since that April 2nd date. We've seen a decent rally in the front end of the UK. It's outperformed its US and German peers in terms of repricing a more dovish Bank of England ahead.
Very interesting in terms of that outperformance, particularly versus its German peers. Bloomberg's Lauréline breaking down the markets and with a look ahead to the central bank action. Thank you. Talking of which, before we get there, we're going to be hearing from the Treasury Secretary on Tuesday. Here's your week ahead then. On Tuesday, the US Treasury Secretary Scott Bessent will be speaking on Capitol Hill. So we'll see if he says anything else that gives nuance and detail, of course, to the trade conversations specifically. Then on Wednesday, you do have that Fed rate decision. Again, as Val was saying, not expected to cut. Traders now pricing in July fully as the next cut from this Federal Reserve in the current cycle. And then on Thursday, the BOE rate decision. And again, as Val was saying, fully expected to cut from the Bank of England. But it's been in the language that we hear, of course, from Andrew Bailey and co. around that decision that will be important in terms of guiding to the future. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. Coming up, oil slumps further after OPEC Plus agrees to increase output, bolstering global supplies as Saudi Arabia issues a warning to the group's overproducing members. We're going to bring you the details on that story next. Plus, later, we're going to discuss how artificial intelligence is transforming the medical industry with the CEO and co-founder of AI healthcare company Corti with a $60 million funding backing. That's coming up. This is Bloomberg.
After a pause in March, a Bank of England rate cut is back on the cards at the next decision day. And markets will be listening to Governor Andrew Bailey for clues on the outlook as the UK grapples with the impact of President Trump's tariffs.
We are certainly now in a world of even greater uncertainty.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts Thursday at 12:30 p.m. on Bloomberg. Context changes everything.
We
look at long-term views on supply and demand to arrive at our long-term oil price forecasts, and we look at a range of prices. So a project that would take several years to develop, like a Deepwater Gulf of America project, and then would be online for multiple decades, our decision-making is really not informed by the price of the day. It's informed by our view of prices out over the life of that project, which can be multiple decades.
That was Chevron Chairman and CEO Mike Wirth speaking on Bloomberg on Friday after the company's earnings on the broader oil space, oil slumping, of course, in the session today on concerns of a global glut after OPEC Plus agreed to boost output by over 400,000 barrels a day from next month. Saudi Arabia signalling further similar-sized increases may follow. For more, let's bring in Horizons Middle East and Africa anchor Jumana Basechi in Dubai. Jumana, just walk us through the rationale of an OPEC Plus decision putting more oil on the markets at a time of falling oil prices.
Yeah, you hit the nail on the head with that question. And clearly, the market wasn't anticipating as big a supply increase as we got out of OPEC Plus this weekend, an increase of more than 400,000 barrels a day for the month of June. That, by the way, brings the total putback of oil barrels back to the market to around 960,000 out of those 2.2 million voluntary cuts that were introduced a couple of years ago. So we're about 44% of the way back in terms of putting those extra barrels back to the market. So the question is why? At this point, I think it's fair to say that we are in the middle of watching a revamping of how OPEC Plus are thinking about their longer-term strategy, i.e., in the past, it had been about supporting oil prices, about oil price stability. Now, the focus is once again shifted back to regaining market share and some of the market share that was lost, in addition to Saudi Arabia warning that they could potentially accelerate even further in the coming months, the putback of those extra barrels. And one catalyst for them doing that is to inject some discipline amongst the overproducing members of the group, particularly the likes of Kazakhstan and Iraq, that have been producing more than what their quota would suggest and putting further downward pressure on the oil markets. And so this is one way of bringing discipline and cohesion back to OPEC Plus again. But of course, the fundamentals, as you highlighted, Tom, are not supportive. You have not just the prospect of a global growth environment that is slowing down on back of tariffs and the trade war, but you also have a big increase in non-OPEC supply growth as well. IEA estimate that this year you could see about 1.5 million barrels per day coming through from the likes of US, Brazil, and Guyana. So taking it all together, even if you have demand growing at around 1 million barrels a day, that's sort of met with by these new barrels that are being put forward to the market by OPEC Plus. What about all of that non-OPEC Plus supply that's about to hit the market as well? Well, this is what you get. Price moves have down more than 4% for oil today. We're back at 4-year lows. And many analysts this morning, Goldman Sachs, Morgan Stanley, downgrading even further their forecast for where oil is going to end up this year.
Yeah, and that's having a corporate fallout, isn't it? That falling lower and falling oil price with that additional non-OPEC supply coming through and some Bloomberg reporting about what this means at a corporate level, particularly between Shell and potentially BP.
Yeah, major story coming through from the team, a Bloomberg scoop, I should say. And the story goes, as you were just reading into me earlier, that Shell are actually weighing up a takeover or some form of a takeover of BP. At this point, it's unclear whether it would go for a mega merger format, whether it would be in the form of share buybacks or particular bolt-on acquisitions. So the point is, Shell are eyeing up their rival quite closely. And if you look at the price performance of BP stock over the last year, it's down more than 30%. There has been a real pushback from some of their key shareholders. Elliott has a 5% stake in BP, and they are saying that they would love to see more of a transformational strategy come through from the CEO. Back in February, he did announce that they're going to start pivoting back to oil again, reducing the focus on perhaps the net zero strategy that was put in by his predecessor. But that hasn't been enough to give the stock some support. And of course, the fundamentals are not helping as well, with the price of oil doing what it's doing. And Shell, for their part, they're sitting on a market capitalization that's about three 3 times the size of BP, obviously rivals. But if some form of this acquisition does go ahead, it could give Shell a foot back in the door again to U.S. assets. Remember, they sold off their assets in the Permian Basin to ConocoPhillips back in 2021. So it could be one way they could get back their foot in the door in the U.S. But as for official commentary, BP have declined to comment. We just put up a comment that we did get from Shell saying, as we have said many times before, we're sharply focused on capturing the value in Shell through continuing to focus on performance, discipline, and simplification. So nothing from them yet. But if it does go ahead, it would be a major deal in the energy space.
Yeah, watch this space. Horizons Middle East and Africa anchor Jemima Pasechi, thank you very much indeed for that update on the macro level and the corporate level as well. Coming up, Warren Buffett is stepping down as CEO of Berkshire Hathaway, leaving his successor a $350 billion cash pile. We have the details next. This is Bloomberg. Warren Buffett has announced that he intends to step down as CEO of Berkshire Hathaway at the end of the year, handing the reins to energy executive Greg Abel. Charlie Wells is here with an update. What is the legacy? It's an incredible legacy, clearly, that Buffett leaves Abel. Just walk us through what some of that legacy is.
Yeah, I mean, Tom, I don't even know how you begin to fill these shoes, right? Because it's just been this astronomical return for Buffett. I believe it's a 5.5 million% return when you look.
5.5 million%.
That's right. It's hard to even say. But between 1964 and 2024, it's that incredible return, turning this basically failing textile manufacturer into a $1.2 trillion company. I mean, how do you repeat that? I don't know that that's possible.
So what does Greg Abel bring to the table then?
So he brings a lot, right? So he's trained as an accountant, born in Canada. He worked his way up through the energy industry. He joined Berkshire in an acquisition in 2000, and he is known as a skilled corporate executive. And this could actually be really important for Berkshire because there are so many different companies, obviously, within the firm. And he's known as a very tactile deal spotter. So again, this is something that Berkshire is known for as well, spotting those deals. And Charlie Munger, before he passed away, said, very importantly, that this is someone who would keep the culture going. And we know the culture at this firm is so important.
And they need to find some deals because they have, what, $350 billion in terms of cash sitting on the sidelines in holding. Is that one of the key challenges that Greg faces now?
That is one of the key challenges. And just to put that figure in context, that is bigger than all of the Ivy League endowments combined. And so, you know, Buffett has talked about a lack of opportunities to deploy that cash, the deals that he doesn't see out there. There are so many questions for Abel. I mean, one of his skills is looking for deals, so maybe he can use that skill set. But also, they've got all these investments to manage. And, right, Buffett is the world's most famous value investor, one of the world's most famous stock pickers. Can Abel pick in the same way? I think that's a huge question as well.
Charlie Wells, thank you. It's going to be incrediable to watch this, isn't it? So towards the end of the year is when Buffett steps down. That 5.5 million%, 5.5 million% return? Yes. Is that right? 5.5 million% yes. Return. 5.5 million% return. You got to keep since the 60s.
Exactly. You got to keep saying it. It's astronomical.
How do you repeat that? Charlie Wells, thank you very much indeed, on the back, of course, of that announcement, and we'll continue to watch what all that means for Berkshire Hathaway, of course, and their investors, and whether or not they can pull the trigger on some deals before the end of this year with that almost $350 billion cash pile. Coming up, a big week, of course, for central banks, with both the Fed and the BOE set to deliver rate decisions. One will cut, one will not. We discuss what to expect with Lauréline Renaud-Chatelain from Pictet Wealth Management. That is next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Donald Trump hints that some trade agreements could come as soon as this week. But in a new front, the US president vows 100% levies on films from outside America. Pump, baby, pump. Brent crude slumps below $60 as OPEC Plus turns on the taps. Meanwhile, Bloomberg learns Shell is studying a takeover of rival BP. Plus, Buffett's bombshell, the 94-year-old sage of Omaha, is to step down as the CEO of Berkshire Hathaway, leaving his successor a cash pile of close to $350 billion. Happy Monday for those of you who are in the office. It's a bank holiday, of course, here in the UK, as it is over in Japan, South Korea, mainland China and Hong Kong as well. A positive session so far, though, in Asia, up 0.6%. Futures here in Europe pointing lower by about 0.1% after 9 straight days of gains. S&P futures stateside also had that incredible run-up, the longest run we've seen in about 2 decades, pointing lower by around 0.7%. NASDAQ 100 futures looking to drop about 128 points. Let's flip the board and have a look across asset. Treasury's not trading yet because Japan is closed. So we'll watch for the adjustment as we build up, of course, to the Fed decision later this week. Have the Bank of England as well. We'll break that story down for you. The non-farm payrolls, the jobs data, strong out of the US. For some markets, traders then pushing back their expectations of when the Fed will come through with that additional and next cut. The Bloomberg Dollar Index is currently down 0.3%. That's lifting the euro, which is seeing some strength so far in the session, up 0.4% on the single currency at 113. The pound is up 0.5% after dropping last week, seeing some losses for the yellow metal. Currently, though, some gains in the session today at 3,258. And Brent, look at that, below $60 a barrel, dropping 3.3%, $59 a barrel right now on Brent on the OPEC Plus decision to put more oil onto the market. But it is a big week for central banks, with both the BOE and the Fed, of course, in focus. Let's get a deeper dive then on what we can expect from the US central bank with Bloomberg's Valerie Taitel. Val, we were talking, and I was mentioning, of course, traders pushing back their view as to when you fully price in the next cut. Not until July now on stronger data. Where is that assessment? Some of the soft data kind of proven a little concerning for the US economy. The hard data is holding up, it seems. Jobs was one of the catalysts. Where do we land in terms of Fed expectations?
Yeah, Tom, that's right. It seems like there is a conclusion out there in the market that we really have to start seeing a weakening in the labor market before the Fed goes ahead with its next cut. And because of that really strong payroll data on Friday, the market is now pushing out its expectations of when that next cut will come. We've seen a big repricing in the front end, so markets are reflecting this kind of sentiment. 2-year yields have risen over 20 basis points in the last 2 sessions, one of their biggest 2-day jumps, Tom, in 6 months. So the market is really on Powell's side here, pushing out those expectations for the Fed rate cut. But the decision this week, the Fed is expected to remain on hold. The Fed funds rate is expected to stay steady at 4.5%. We have seen the likes of Goldman and Barclays push out their calls. They were previously calling for a Fed cut at their next meeting in June, now seeing it until July. So this seems to be the theme as the hard data continues to hold up in front of the weakening soft survey data that we have gotten. But aside from the central banks, Tom, we really need to focus on the trade deals that are being negotiated by the U.S. and their counterparts. We have to mention what's been going on in Asia FX. Take a look at the Taiwanese dollar. My goodness, strengthening another 4% today. This is leading to some curious conclusions out there, Tom. Some people discussing whether the fact that maybe FX is on the cards in these trade negotiations. Because why is the Taiwanese central bank standing by as their currency strengthens more than it has done in 2 days in over 40 years? Taiwan does have a very large trade surplus with the U.S., and perhaps there is a view that the U.S. is pointing fingers at their weak Taiwan dollar policy as perhaps a non-tariff barrier they wish to get dismissed.
OK, we continue to watch those remarkable moves then in the Taiwan dollar that you flagged for us on Friday. Of course, Valerie Taitel keeping across that move, plus, of course, the preview in terms of the central banks. Let's get more market analysis right now and bring in Lauréline Renaud-Chatelain, senior fixed income strategist at Pictet Wealth Management. Lauréline, good morning. Thank you for joining us. I want to start on the Federal Reserve then. Do they hold the line until July then on this stronger data, or are markets mispricing the Fed's next steps?
Good morning. So yes, exactly. In our scenario, we always had July as the first time they would cut for this year. And then we do expect that they go at every meeting. We believe by then we will have enough hard data that has been softening. And regarding, for example, the job report, we believe that May will be the first moment where we could start to see the impact of the trade war, I would say, on the U.S. economy, especially on the job market. And we do not expect the Fed to be preemptive. We really expect the Fed to act once hard data has started to disappoint and show a slowdown.
Is that impact going to crystallize itself then? Will that impact crystallize itself in a recession in the US? Is that now becoming a base case for the team at Pictet?
Yeah, so no, it's not a base case, but we do reckon that if we do not get any trade deals and the reciprocal tariff that have been announced on April 2 do come into place, we could have a higher risk of recession, something around 50%. Now, the fact that Trump has been quite positive, saying that some trade deals could come, is obviously bringing some relief in the market. We have seen the risky part of the market rallying, especially credit spread tightening. So this is really something that is at play, and the market cannot be disappointed, I would say, for that to continue.
How much confidence do you have in Fed independence at this point? We get to the point where this is a Fed that's not cutting again until July. I just have to question to what extent President Trump's patience holds until then.
Yeah, so we have seen a lot of noise, but the fact that he kind of came back saying, OK, I'm not going to fire him, I think key will be to watch who is his nominee for replacing Powell. And according to Bess, and this is something they will start discussing in the second half of the year. So that could be also something that the market will analyze very thoroughly, analyzing if the next chair will be as independent as Powell has been, obviously, because it has a big influence. But at this stage, I would say we're not too worried that Trump will fire him, which I think came to a relief for markets, and especially Treasury yields at the long end of the curve.
And do you see that risk premium in Treasuries being sustained for the medium to long term? Is that something that investors now have to price into their models?
Yeah, definitely. So this is something we always had highlighted. Honestly, first, because of the fiscal concerns that we have. I would say now that given the risk of trade war, we discuss also the fact that you could have long-term investors, especially central bank from emerging markets, that would like to diversify away from treasuries. That could have an impact for sure on the term premium over the long end. But I would say that key to watch in the coming months will be the fiscal deficit. As you know, the new budget is being discussed. There are announcements for large tax cuts to be implemented again, and that's obviously putting into question the long-term sustainability of the US debt.
And that diversification story has arguably benefited European sovereign debt with the rally that we've seen, particularly in Germany. No deep concerns, it seems, about the fiscal spend that's coming there. What are your expectations about how far that can run? What do you want to be looking at positioning in when it comes to the sovereign debt? You prefer Euro sovereigns over the US at this point?
Yes, exactly. I think there are two reasons for that. The first one is that the inflation path is much clearer to us in Europe. So you have these inflationary forces that are very clear in Europe. First, the fall in the oil price that is feeding through headline inflation, the strength of the euro that is having a big impact as well as a disinflationary force, the fact that we could have rerouting of Chinese goods as well into Europe. And then on top of that, we have good sign in terms of the wage tracker from the ECB that is signaling that wage growth is moderating and that should fuel into services inflation. So on this side, we do believe that the ECB has room to cut much more, to become actually also stimulative, because the inflationary picture is much clearer. And so we are overweight on euro periphery sovereign bonds in particular, because that's where you get still an important yield. And we also like overall the euro curve.
Where does that leave benchmark rates then in Europe by the end of the year? Because the markets are pricing in the rates get to about 1.5 by the middle of December. But you think they go more? You think they go lower than that by the end of the year?
So I would say 1.5 is in line with our central scenario, but we have risk tilted to the downside. So the thing is that basically we are more or less in line in terms of forecast with where the market is currently trading. But we believe that the surprise could come with much lower yields. So at this stage, what we've done is really decide that we prefer to have exposure to the euro curve in our accounts. And in this sense, we believe that if we have a recession, for example, in the US, and that spreads into Europe, we know that the ECB can go much more aggressively. And they have discussed actually 50 basis point cut in their last meeting. So this is also something they could surprise us with if things deteriorate fast.
Where does that potential US recession leave vulnerabilities in the credit space?
Yeah, definitely high yield to us is the weakest link. What we have seen over the last few months is really the fact that default rate has been hovering at elevated level, more on the leveraged loan market than on the bond market. But we've seen a lot of distress exchange. Private credit funds have not performed well year to date. So you see that the elevated cost of funding is becoming a problem in an economy that is slowing down. And at this stage, what we would believe is that you have risk of higher default rate than when the market is expecting. And in this sense, credit spreads, especially US high-yield credit spread, are way too tight at the current juncture under 400 basis points.
OK. Lauréline, Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth Management, really setting us up well for these central bank decisions, of course, with the Fed and the Bank of England later this week. How to think about credit as well and some of the pressure points there in a US recessionary environment, if indeed that's where we end up. Now, some of the stories making the news. This Monday, in Romania, an ultra-nationalist aligned with Donald Trump is through to a presidential runoff against the centrist mayor of Bucharest. George Simion of the Alliance for the Union of Romanians secured 40% of votes in this weekend's first round, far ahead of independent Nicu Sodan, who took 21%. The candidate, backed by the ruling coalition, was eliminated. The two will go head-to-head in a final election later this month. Australian Prime Minister Anthony Albanese has won a strong mandate to overhaul the nation's economy. His Labour Party returned to power in Saturday's election with an increased majority. Voters rejected the Trump-style populism of the Conservative opposition, led by Peter Dutton, who lost his seat in Parliament. Albanese says he received a phone call from President Trump following the vote, describing the conversation as warm and positive. In another election, Singapore's Prime Minister Lawrence Wong has secured a strong mandate in his first electoral test, with voters choosing stability amid the turmoil of the Trump trade war. The People's Action Party took 87 of 97 seats in Parliament, with Saturday's election suggesting a renewal of public trust in a political party that's been in charge since independence in 1965. Israel's Security Cabinet was set to meet on Sunday to approve an expansion of military action in Gaza ahead of a planned visit to the Middle East this month by President Trump. Over the past 50 days since the temporary truce ended, Israel has repeatedly threatened to escalate until Hamas agrees to release remaining hostages. The Israeli military has since taken over about a third of the Palestinian territory and cut off humanitarian aid. Coming up, I'm going to be joined by the CEO and co-founder of AI healthcare company Corti. We're going to discuss how the technology is reshaping the industry and how Europe can compete with the US. That's coming up. This is Bloomberg. We have some breaking news across the terminal right now. The Redhead crossing on Taiwan. The central bank on the island saying they will hold a press conference at 4:30 p.m. on what is happening in the FX markets. We've had some remarkable moves around the Taiwan dollar. The strength that has come through. You can see intraday the gains of around 3.5%. But if you add that on to what's happening on Friday, you've seen moves that we haven't seen for decades in terms of the strength coming through from the Taiwanese dollar. And surprise for some that the central bank has not stepped in to smooth out some of these adjustments. There's a lot going on here. There's speculation that maybe it is tied to the trade conversations between Taiwan's leaders and their US counterparts. That is just speculation at the moment. Maybe we'll get more details then with that press conference from the Central Bank of Taiwan at 4:30 p.m. on what is happening in the FX markets. Let's switch focus from FX to what's happening in tech and AI then, because Elon Musk has said that AI should be used to replace the functions currently done by some public workers in the US government. But how can the technology improve efficiency in the country's bloated healthcare sector? I'm joined now by Andreas, Cleve, CEO and co-founder of AI healthcare company Corti. You've raised, about 60 million US dollars. One of your key backers is Atomico. You've done some big deals recently. Andreas, thanks for coming into the studio. Just outline for us what you guys do. What is the gap that you're filling? What is the proposition around healthcare and AI? There's a lot of speculation, a lot of hype around this space. What are you doing that's material and consequential?
So we compete with the likes of OpenAI, but we only do it in healthcare. So we build an infrastructure that lets builders, clinicians, technology companies who want AI inside their apps, but won't want to have the vanilla, risky, hallucinogenic AI in their apps. They would want something specialized for healthcare. That's where we come in. We let them build AI apps that's safer, that hallucinate less, that's built for purpose.
How are you're putting yourself up against OpenAI then? There's a point, is there not, the critics would say, or the skeptics would say, where OpenAI and others, Anthropic, they cannibalize this space, they eat your lunch. What is the moat now between you and OpenAI on this?
It's a great question, and I think it spills into why we at Europe still have a lot to do in AI. AI isn't this $1 trillion problem that a lot of people, outsiders, tend to think. It's $1,000 billion issues that are highly specialized because healthcare is specialized. So to be able to build for healthcare, you need to be a highly specialized technology where you're not sort of after the fact figuring out trust. You need to build it into the broth of your solution. So we can make a lot of architecture decisions that a big company like OpenAI would not. And that makes us much more fit for purpose and much less riskier.
What does it mean then on the ground for consultants, nurses, hospital managers, using your technology? What does it actually look like in real terms? What are you empowering them to do? Give us some metrics in terms of how this has actually worked on the ground to create efficiencies, speed up these processes, and make sure that health outcomes are improved.
Yeah, so it's all about making sure that we as patients have more time with caregivers. And I think a lot of the bloat on the healthcare sector is wrong. We lack more than 10 million professionals at the end of this decade, and we as patients want more and more care. So the job for a company like us is building this infrastructure that lets you build these AI apps with a lot higher quality to remove some of the pressure, especially from the administrative burden, and allow AI to fill the gaps where need be. And that all of a sudden will move people away, hopefully, from paperwork into seeing more patients.
What's the potential size of this market?
It is a $1 trillion problem in the U.S. alone, handling just the sectors. That means doing anything from documentation, administration, quality assurance, coding, it's called when you want to be paid for it. This entire blurb is a $1 trillion problem of $1,000 billion problems. And there we need a different kind of solution than just scaling employees. We need smarter technology.
What does this mean for the workforce within healthcare, longer term?
I think we have a workforce that is overburdened, that is stressed. For many of them that are burning out. Fewer young people want to join the workforce. It's less attractive than ever before. So hopefully this is part of turning it around, giving supportive technology actually built to support, that actually helps, that actually gives you time with patients instead of paperwork, as I think nobody sort of took the Hippocratic oath to become an expert in systems.
You're a Danish company, but you are based in New York. Is the US is a priority market? Walk us through what the US looks like for you.
Yeah, half our customers are American. So we are covering 10 countries, two continents, and generally what we see in the US is it's a very forward-leaning, AI-friendly environment. A little bit less organized around trust and risk as we are in Europe, but also very open to new solutions.
What is the trust deficit right now? Convincing health practitioners, but users as well, customers, patients, that you can trust this technology?
That's the big gap. So 80% of healthcare projects that is about AI is stalled in pilot paralysis. 80%. And that's a big issue, of course. And if we dive into the numbers, 73% of UK physicians still haven't used AI professionally. They've maybe tried some privately, of course they might, but professionally they're not using it yet. But still, 73% want to use it. So if we have all these doctors who want it, we have a healthcare industry that needs it, but we're still stuck in pilot paralysis. Like, what's the deficit, to your point? That's trust. And trust is not something you find or something you get, it's something you earn. So our job is getting it into the hands of more and more people, making them see it hallucinates less. So when it helps you write your documentation, it feels right. It learns from you. It understands the medical language. It's not just sort of dabbling in it, it's built for it.
OK. Andreas, thank you very much indeed for coming in bright and early on the growth and the expansion into the healthcare space. Corti AI, trying to take on OpenAI in this space. Andreas Cleve, Corti co-founder and CEO. Thank you. There's plenty more coming up. Stay with us. This is Bloomberg.
Wednesday, the Fed decides.
It is the central banker's dilemma. Downside risk to growth, upside risk to inflation.
They are wait.
This is a serious moment. I do not think the Fed can just sit on the side.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
They're expecting stagflationary-like environment.
They are going to be on hold until they have hard evidence one way or another.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Welcome back to Bloomberg Daybreak Europe. So the jobs data out on Friday came in stronger. That led to readjustments, particularly at the front end of the US Treasury curve on expectations. So this is a Federal Reserve that can sit this out longer. That some of that data is suggesting there is continued strength when it comes to the labour market and more broadly across the economy. A little bit of resilience still. We are not at recession territory yet for the US, and so the Fed will stay on the sidelines, at least for now. Market's not pricing in, by the way, the next cut fully until July of this year. Expectations that maybe you get about 80 basis points of cuts by the end of 2025, with the rate around 3.5%. It's a different story when it comes to BOE. You'll end at 3.5%. That's the market expectation. Let's flip the board from the Bank of England by the end of this year. But that will involve more cuts coming through starting this week. That is the market expectation. You get possibly 92 basis points, so almost 4 full 25 basis point cuts from the Bank of England. There's still that services inflation challenge, and there's still a less clear path than there is for their counterparts at the ECB. So the language that we get from the BOE, Andrew Bailey and co. this week will be important as well in terms of framing where the Bank of England goes. But you are expecting to see markets see to about 3.5% by the end of this year, with the next cut coming through this week from the Bank of England as the Fed stays pat, of course. Let's flip the board and have a look at what's happening in the oil space. Some remarkable moves there in terms of the downside pressure on oil, with OPEC Plus deciding to put another 400,000 barrels of oil onto this market from June. But there's this divergence in terms of the inability then for OPEC to put more barrels on the market. They're setting these targets around production, but they're not necessarily meeting them. The rationale seems to be that Saudis and others are trying to put pressure on the likes of Kazakhstan and Iraq, who have been pumping more than their quotas. Prices continue to drive lower. You're below $60 a barrel on Brent right now, and yet increasing that production materially isn't necessarily coming through. This ties back, of course, to the central bank story in terms of lower inflation. Good news, arguably, for the central bankers as oil prices continue to be under pressure. Not seen below $60 a barrel since about early of 2021. So those are the moves on oil. The opening trade is up next. We'll discuss this. We'll get some more details and analysis around how to think about the central banks and, of course, the latest on Trump's comments around potential trade deals, possibly as soon as this week. The opening trade is up next. This is Bloomberg.